Welcome to Channel 17, the Town of Colonie Government Channel.
Hello and welcome to The Money Factor. I'm Richard Naylor, your host. Today's topic is 2009 income tax, some rules and regulations. Our guest is Patricia Catchpole. She's from the Wolf Road office of H&R Block. I want to welcome her back to the show.
Thank you. Thank you, Richard. It's a pleasure to be here.
Great. This topic comes up every year, whether
every
we like
year
it or
in
not.
February, yeah, whether when tax time comes, it means spring is not far behind.
Right.
And that's a good thing today.
That's true. And I know that the accountants and people who work in taxes, as it gets towards April, I would never get you on the show.
Probably not. No, no. We prefer to do this kind of thing in February or March.
Right. While people are still putting things
People
up.
are still putting things together and still have time to benefit, I hope, from some of the things we'll talk about today.
Great. Let's start with, which is always interesting, kind of like what's new.
What's new? A number of things because of the American Recovery and Reinvestment Act. Is that what it's called? I'm not even positive.
So. I have a hard time with the alliteration.
Anyhow, broadly, this is part of the stimulus package that was passed last year, and there are a number of measures either that have been in the works or that were legislated last year to stimulate the economy, move things along. A lot of the benefits depend on where you are in life, if you're working, if you have children in college. Just about everybody who works is going to see a credit on their tax return for the Making Work Pay credit. If you have children in college, they've revamped and expanded and made the college credit much more beneficial. It's a partly non-refundable, partly refundable credit, but any of my clients who have children in college are really liking this year. I mean, that's a very good thing. And then there are a plethora of items. Energy improvements to your home can yield a credit of up to $1,500 if you purchased a new car, and brand new, not new to you, but brand new, after February 16th or 17th last year. There's an extra deduction available for sales tax on the car. There is, of course, the ever popular and soon to expire new homeowners credit, which was expanded in late 2009 to include current homeowners. And if you're thinking about that, you need to get busy because the credit will expire this year. And unless it's extended again, you need to have a contract by April 30th, and you need to close by, I believe it's June 30th. So
get your taxes done by the 15th, and then your house
and then you can go
by the 30th.
That's right. Then you can go house shopping. So those are all. And again, our taxes are not just about collecting money. They're also about targeting particular industries. The new home buyers credit was designed to help the housing industry. The sales tax deduction on cars was designed to help out the automobile industry. Making Work Pay was just designed to put some money in people's pockets so they could go spend some money.
Maybe buy that car.
That's right, exactly.
Now, how much was that credit for? Is that a set amount?
It's a set amount, $400 per person. There are some income limitations, so I believe if you're earning more than $150,000 or $160,000 as a married couple, the credit begins to phase out.
Oh, so it's not.
It's not for it's.
Doesn't just drop off a cliff.
Right. It's not. Well, yes, it's one of those phase out credits.
Okay.
There is a little bit of a pitfall that anyone who's retired and collecting Social Security and working may find, because this $400 Making Work Pay credit is incorporated with the $250 economic recovery payment, which was made to recipients of Social Security benefits.
Does that mean you get $150, or does that mean something else?
That means you get $150.
Okay.
The maximum credit is $400. So if you were collecting Social Security or a veteran's benefit, if you're a disabled veteran, or if you have a railroad retirement benefit or a supplemental security income benefit, that $250 came to you automatically.
Now, you used the word credit.
Yes.
in this case. So well, let's explain the difference between
Okay.
just for some people who might not know.
This is a credit is the best.
Right.
Okay, a credit reduces your tax. A deduction reduces your income. So these credits are, we say they are refundable, meaning you get them no matter what. You don't have to pay them back.
So if you ended up with everything that else you did and it was zero and you had a
Right.
$400 credit, you get $400.
You get your $400 even if you've zeroed out everything else.
Right.
But if you are collecting Social Security and working and you received your $250 payment last May, your credit will only be $150 because you've already received the sum of all these
Part of
credits is capped at $400.
Okay. That's maybe
So,
a good way to put it.
right.
Let's see, the education part. You said a lot of people are excited about that.
A lot of people are excited about this because we just talked about credits, refundable and non-refundable. The education credits used to be non-refundable, meaning you needed to have tax in order to subtract the credit from your tax to get the benefit.
Okay.
Now you can zero out your tax and a portion of the credit becomes refundable, so you get that portion back whether you owe any tax or not.
So I've learned a new word. This
Yes.
is non-refundable and refundable.
Refundable credits are the best.
Okay.
Okay, because you get them whether you've paid in any tax or
Okay.
not, as long as you meet all the other
And
requirements.
so this is just a general credit for college tuition?
College tuition, there are some income phase-outs. Once again, the income phase-outs have been raised, so more taxpayers are covered. And that's a big help because there were some people whose income was, say, in the $130 to $150 range who didn't get the benefit of the old credit, the HOPE credit, which was the father of the new credit. This is
Okay.
the American Opportunity Credit, I think it is. If you're doing your taxes and you have children in college, you need to look into this because it's wonderful.
It gets a little confusing.
Oh, it does, yes. And there's an ordering to these credits. If you qualify for the new credit, that's the best one to take in almost
Okay.
every circumstance.
Now, it made me wonder because it seems like through the years with education costs, things have sometimes been deductible and sometimes been something else.
Right.
And it, like, let's say somebody's working, they go to community college, maybe 6 hours.
Right.
Is that still deductible?
That is still well, now, once again, it depends.
Deductible.
Yeah. Yes, there is a deduction that exists still. There's another credit that exists. The American Opportunity Credit, the really good one that I'm talking
Okay.
about, applies if you are a more than half-time student. Okay, so that applies to somebody who's
So
going
not the
to
night school.
If you can be going to night school and if the college considers you more than half-time.
Okay. Which would be, what, 3 classes?
In
or-
general, it's up to the college.
Okay.
If the
Could be
college
2,
considers you
maybe.
full-time, you're full-time. Sometimes it's number of credit hours.
Okay.
So if you're taking perhaps a 4-credit course and a 5-credit course, that might qualify you for more than half-time, even though you're only taking 2 courses. So that's the American Opportunity Credit, but that's really for full-time students. There
Okay.
is still what we call a lifetime learning credit, and there is an education deduction where you can deduct tuition up to $4,000 from your income. So those are still available, but they would be available if you don't qualify for the
Okay.
other
And I think
credit.
that's so important to people
Oh, yes.
going back to school.
Yes. Yeah.
Because if you can't afford to go back to school, now you have another problem.
Right, yeah. And obviously, credits are going to be better than a deduction. The lifetime learning credit allows you to deduct 20% of your tuition and gives you a credit of up to $2,000, 20% of $10,000.
Oh, well, that's very helpful.
Which is very helpful. For some people, that is going to be a better deduction. For other people in a higher tax bracket, the adjustment to income may be a better way to go. So you have to look at once you get past the American Opportunity Credit, you really have to look and see which one is going to offer you the best benefit.
Let's move into the energy just for a second.
Okay,
That was
okay.
the third thing you mentioned
yes,
in terms
energy.
of this American Reinvestment and whatever it was.
And Recovery Act.
Yes.
Yes. Energy credits have been around for a long time. I think we had some in the 80s, then they went away, and then they came back in 2006 and 7. They went away again in 2008. Now they're back for 2009 and will continue to 2016.
Oh, well, that's a long time.
Which is a long time. So if you missed getting a deduction in 2009, you still have an opportunity to do so for the next 6 years. The credit is maxed, it's a cumulative credit. The maximum credit you can take from now through 2016 is $1,500.
Okay.
It applies to things like windows, doors, insulation, things you have installed in your home to save energy.
Now, that doesn't sound like something that would offset a solar project. You need something else, I guess.
Yes, the solar and wind and photovoltaic, and those are extremely lucrative credits if you're doing this. I mean, you know, you can. There are state credits as well for some of these little. Basically, you're setting up a mini power system in your backyard.
Right.
There are state and federal credits for some of those things, and those are more specialized. If you're working with somebody and you're interested in wind or photovoltaics or any large, well, I say large scale, it would be small scale compared to a power plant.
But
there
for an individual,
individual, whoever the retailer is, whoever the manufacturer is, can tell you exactly how much the federal credit is, how much the state credit is. Often there are interest-free loans. You know, let's say a project is going to cost $40,000, and there are credits that will reduce this cost to $15,000 or $20,000.
Oh, that's huge.
So you're out of pocket $15,000 or $20,000.
Right.
There are some programs that give you interest-free loans where, because let's say I do a project now, I'm not going to get my $15,000 or $20,000 credit till a year from now when I do my taxes.
Ah.
The manufacturer, the retailer expects me to pay this in full. So there are low-cost loans available to get you from now to the time that you actually get the credit.
Well, that's helpful.
And the best,
kind of like a bridge loan.
Yes, yeah, kind of. And those the people who do these installations, they're very up on how.
So that's the way to go to find out about
Yes,
that, because it's so tricky and changing and
right. And they can really guide you if you're doing any of these credits. One caution I would give people is. In addition to the windows, doors, and insulation, new furnaces qualify as long as they meet certain energy efficient standards, and these must be very efficient. I mean, a manufacturer or a retailer can tell you if they meet the Energy Star requirements. If, as a consumer, you're out shopping for a new furnace, make sure that you're getting your quote for the entire furnace, not the quote after your rebate of $1,500. Because some retailers say, well, this is only going to cost you $3,500.
So now you're counting on reducing it yourself, but because they've already reduced it,
right.
That's really what it's going to cost.
That's really what it's going to cost, but you still have to come up with $5,000 to pay for this because it's a year from now. And this $1,500 credit is cumulative. So if you did enough windows to get a credit of $1,500 this year, there's no more credit left for a furnace next year. That's $1,500 is the cumulative credit from now through 2016. It's not $1,500 a year. So that's another thing.
So you can't just dribble it out and.
Well, you can dribble it out.
But only up to $1,500.
Only up to $1,500. So if you did $200 this year, $300 next year, that you can do until you get to $1,500, and then it stops.
Now, when I was trying to find some questions, so I would have some sense of what's going on.
What's going on? Yep.
I came across the word homeowners, and that seemed to be something, but I don't understand what that is in terms of the reinvestment and the Recovery Act.
Well, actually, it's homeowners and home buyers. First-time home buyers was where
that's what. Okay. And you had mentioned that.
That's where it started with first-time home buyers, and there are phases to all of this. There were the first-time home buyers from 2008, the first vanguard of first-time home buyers. And they were eligible to receive a credit of $7,500, 10% of the purchase price up to $75,000 for a credit of $7,500.
So it still was better for first-time buyers, probably.
It was, and it was a good thing, but if you talk to some of these people, there's a little consternation because this credit must be paid back.
How does that help as much then?
Well, it's an interest-free loan. It's paid back over
Over 30 or 15?
10 or 15-year period.
Oh, but then
And
that does help.
it doesn't start until 2011.
Okay.
So-
and then there's inflation that's eating away what you
right,
owe.
Right,
So
and it just comes right, it reduces the amount of your
definitely
refund.
a good deal. It's like a loan
Right.
in reverse.
Yes, okay. And that's definitely a good deal, but if you bought your house in 2008, you were probably not thrilled because in 2009, they raised the credit to $8,000 and said, you know what, you don't have to pay this back.
Oh my gosh.
Okay.
Yes, you would.
So
Your
some of
house
those
is going
people
down in
are,
value and
some of these people are like, no, why didn't I wait?
yeah.
Individuals who bought a house in 2009 could either claim this credit on a 2009 return or on an amended 2008 return.
It's good to know.
So we did a lot of new home buyer credits last year. People bought their home in the spring of 2009. We amended their 2008 or added it to their 2008 return.
Okay.
So they got their credit a year early. Then as it got later in 2009, it made more sense really for individuals to wait and make this part of their 2009 tax return. And then Congress tinkered with this one more time late in 2009. It was supposed to expire in, I want to say November, but I'm not good at remembering all these dates of
That doesn't
enactment.
matter anyway.
Okay. And they said, well, we'll extend this just a little bit more into 2010 with the understanding that you must have a contract for a purchase by April 30th. You must close by June 30th.
Huh, okay.
And to add a little more sweetening to the pot, they said, if you are an existing home owner and have lived in your home for 5 out of the past 8 years, and you buy another home, and it could be a replacement home, could be a vacation home, could be a second home, you're eligible for a credit of $6,500. So existing homeowners got a credit or have a credit eligible of $6,500. That also has this April, June, and there are some income limitations on this. I think the phase out for this is 150 to 180-ish. So again, doesn't apply to everybody.
Okay.
But lots of activity, and you've probably seen signs at realtors, you know, $8,000 credit available, and it's not too late.
I haven't actually, but I think people probably who are interested in a home, they see those signs.
Yes.
To me, they're invisible. I'm not going
You're not
anywhere,
going. You're not
buying
looking.
anything,
Right. So that has put a lot of. It has paid for a couple of weddings actually.
Oh wow,
that
that's
I'm aware
nice.
of. Yeah, I did returns for a couple of people, and they took their first-time home buyers
that's
credit
great.
and used it to pay for their wedding reception, which again the idea was to put some money back into the economy, and it did. I mean, they had a lovely reception.
Well, anyway, they saved money, and I guess
Right.
the mother of the bride's happy too.
Right, everybody's happy. So.
If we don't go on to something else new, it might be, and we could always come back, but
Sure, yep.
this would seem to tie into some of those things. The economy has been a bit problematic.
It has, yes.
Called a giant recession or something. Okay, so we've had a lot of foreclosures, we've had a lot of loss of
Yeah.
home value.
Yes.
Bankruptcies because of various things.
Right.
Could we talk a little bit about some of the tax implications of
Sure.
foreclosure
Yeah,
or
and I think we'll be
bankruptcy?
seeing, I expect we'll be seeing more of that as the tax season wears on, and even into next year. People don't understand this in many respects, so I'll just start off by saying that. When you have a mortgage, you're committed to the bank to pay back, say, $500,000. And behold and lo, your house is now only worth $300,000 because the market has gone south, you've lost your job, you can't pay back this $500,000 mortgage. And so although
And
you're
the house isn't even worth.
the house isn't worth $500,000 anymore. So you
Can't just say, okay, we'll take the house because
right.
it's not enough.
It's not enough. And although you may be reluctant to do this, the only way out is through bankruptcy, perhaps, or through foreclosure. And the thing people need to understand is that forgiveness of debt, which is what happens in these circumstances, is considered income to you.
Double whammy.
Double whammy, unless...
Or like a boomerang, it
yes,
came back.
Yes, well, because, and think of it this way, if I say to the bank, I promise to pay you back $500,000, and if then the bank says to me, it's okay, we understand you can't pay it, you don't have to pay this back, then I've received a benefit, because that commitment I made to pay $500,000 back over 30 years is gone.
Never mind that you lost $200,000 in the process.
Right. Okay. The way Internal Revenue Service sees it is, I have a $500,000 benefit that is
Wow.
like taxable income. Now, that's the broad rule. Then there's some exceptions to this. If this debt is forgiven in bankruptcy, it's not included in income.
So the IRS is considered a creditor in a way.
Well,
in the bankruptcy court.
Oh, yes, yeah. So anyhow, but if I'm in bankruptcy, this debt is not considered income to me, because basically I filed for bankruptcy.
Right.
To say, if I did not file for bankruptcy but have more liabilities than assets,
And you just let it foreclose.
and let it foreclose, then to the extent my liabilities exceed my assets, which often happens in cases like this, then if my liabilities are greater than my assets, that difference is going to be excludable from income. So there are some cautions, there are some cushions. When you have a foreclosure or a bankruptcy and there's property involved, you will often get a Form 1099A or 1099C. This is not a form you can ignore.
Okay.
Okay? All right? If you get one of these, you don't want to look at it and say, oh, that's because of the house,
And just file it
away. Okay? And occasionally you'll get these even for a credit card debt that's been forgiven. And sometimes these notices will come out a year or 3 after,
Ooh.
And you get this and you say, oh, that's from something I did 2 years ago. And don't forget about it, because
Wow,
because
there's no statute of limitations
no,
here.
well, you'll get a letter a couple of years later saying, how come you didn't report this on your tax return?
And then do you owe a penalty?
You owe penalty if you owe tax because of this.
Ah.
Okay, but again, suppose you run up your credit cards, and we won't talk about being responsible or irresponsible. Sometimes you have to live on your credit cards. I mean, that's,
Well, medical emergencies are a
or whatever.
devastating
Yes,
event,
yeah,
for example.
absolutely. And and then if you lose your job on top of that, if your liabilities exceed your assets immediately before this debt is discharged, then if they're equal to the amount of discharge, the excess, this is not going to be income to you. It is much easier to handle something in a timely fashion, or as timely as possible, rather than to be going back through your records that existed 4 years ago. So,
Your
it's...
memory is totally gone.
Right.
So everything is records at that
Right.
point.
I mean, we're talking now, we're doing 2009 returns. If you settled some credit card debt in 2007 and forgot about it, and you get a form this year, you should not ignore it, because a year or 2 from now, you'll get a letter from IRS inviting you to explain where this came from, why it's not income. Now it's perhaps 2011, maybe 2012, and we're talking about an event that occurred in 2007. So, I mean, you may, the closer you handle things like this, the better off they are to when the event occurred. Because you just have more records available, and it's
And if you
easier.
know this is coming up, you don't want to have this sitting on your mind for
Right.
2 years.
No. And sometimes, people will do this and they'll work with a credit card company, or they'll hire an attorney, and they'll be told, don't worry about this isn't going to be taxable, which is true in most cases, but that doesn't mean that you don't have a reporting requirement.
Okay.
You still have to put it on your return and say, yes, I had this forgiveness of debt, but no, it's not taxable, and this is why.
So that's the easy way to get it all cleaned up and
Right.
those loose
Report
ends.
it and tie up the loose ends, and you file a form and you say, basically, my liabilities exceeded my assets, therefore I don't have income.
And that's good.
Right, yes.
Well, it's not really good.
Well,
but
it's not good, but it doesn't compound the problem.
Right, thank
2
you.
years later, getting a bill, gee, you had $5,000 of debt forgiven, and now you owe us $1,200.
Let's move into capital gains.
Okay.
Just a bit.
All right.
Sometimes they change. Are we going to have to pay them? Are they cutting them? Or
What
when do we
happens to
have to
them?
pay them? What's going on?
Right now, there are people who would really love to have capital gains because the value of their portfolios
Okay.
is so diminished
Give me a gain.
that they'd be happy to have gains to pay tax on. And that's something just a little bit off the topic. We're noticing too this year, people who live on, who have bank accounts, fixed income, interest rates are down significantly. Many companies have cut dividends. But for people who have capital gains, the capital gain number has been a moving target for the past few years. Typically, it is lower than for the marginal tax bracket rates. Right now, if you're in a 10 or 15% tax bracket, your capital gains are zero. There's no tax on your capital gains. If you are in a 25% bracket or above, the marginal rate for the rate for capital gains rather is 15%.
Now, it has been higher, right?
It has been
some
higher.
years
It's
back
been 20.
Right.
It was 20. It can be higher for higher income individuals because, and now I'm talking about individuals who might have retired and have a pile of company stock. They sell $500,000 worth of company stock for a $300,000 or $400,000 gain. They have a $20,000 pension, and you'd say, oh, they're not all taxed at the 15% rate because they would likely be liable for that old bear alternative minimum tax. So that can come into play if your income is high enough.
So you need to know the tax consequences if you're going to do something.
If you're going to
like
do
that.
something like that, yes. You know,
Okay.
because you could be off. If you're thinking I had a gain of X dollars times 15%, it may not be just 15%, maybe more because of alternative minimum tax. And just as an aside, New York State doesn't offer any special rates on capital gains at all.
Okay.
All right, it's very easy on New York to get to the highest bracket. Most people effectively are in like a 6.85% bracket, and I tell there is one bracket higher than that. I say for New York, just figure 7% is a really good number to use.
Okay. Could you talk a little bit about the brackets themselves?
Sure.
There are 5, is that right?
6 actually right
okay.
now, 10, 15, 25, 28, 33, and 35.
Okay.
Okay. And I'll use married filing jointly just because that's a kind of good jumping off point. And I don't memorize all these numbers all the way up, but understand when you talk about tax bracket that we're talking about taxable income, not gross income.
So when you're all done, that bottom line, this is your taxable income.
This is your taxable income. So we've subtracted your mortgage interest and your property taxes, your standard deduction, your deduction for dependents, and there's a line that says, this is your taxable income.
There it is.
And the next line says, look up your tax.
Right.
For a married couple, the 10% bracket runs to just under $17,000. So the first approximately $17,000 of your income is taxed, of your taxable income is at 10%. Then the next bracket runs from about 17 to about $67,000, I believe. That's the 15% bracket. So the first 17-ish at 10%, the next increment is 15, and then from about 67,000 to about 137,000. That's the
a big
25.
range,
That's
yeah.
that's where 15 and 25 is where most people are.
Right.
At least most people whose returns I do.
Right,
Okay.
right.
All right.
Right.
If you are single, the amounts are roughly half that. So instead of 17, roughly 8,500. Instead of 37, roughly, what is that?
18.
19. Okay, and then 137. I mean, and then head of household is roughly in between
Okay.
the single and married filing joint. Once you get past the $137,000 of taxable income, the next bracket's 28%, and that probably goes to over $200,000. Once you're in that taxable income range, up into probably over 150 to 250-ish of taxable income, other things start to happen on your tax return. And as you get above 250, even more things happen that effectively...
That magic 250 we've heard
that,
about
yes,
so much.
it raises your effective rate because you don't get as many of your itemized deductions. It says, if your income is over this amount, we're going to take some deductions away from you. If it gets much higher, we're going to take some personal exemptions away from you. So the brackets marginally are what you see, but as your income goes up, the brackets effectively become higher. If you encounter alternative minimum tax, your bracket effectively becomes 26% or 28%, depending on how high your income is. And in alternative minimum, you lose a lot of deductions and then basically get a very large standard deduction, and then it's 26% of what's left or 28% of what's left.
We're getting close to time, but I want to cover two more areas, even if it takes a little longer.
Okay, all right.
One is e-filing.
Okay.
You know, I've heard more and more people are doing it. I think at first it was a little slow, and when you look at it and they want to charge you to file, I think some of us say, well, I'm already paying taxes. Why should I be paying to pay taxes? Of course, if I've got expertise, that's different, but I'm helping the government. It's like using, to me, a cash machine when I know they don't need somebody in the bank now. And,
right.
But nonetheless, what's going on there?
Well, right now, e-filing is I shouldn't say no state. It doesn't cost anything. The state or the federal government does not charge you if you e-file your tax return. I think there was a proposal floating around last year. The state was looking for revenue. Of
course.
Again, always.
Right.
And that was one of those proposals that was floated in very quickly, just for the reasons you pointed out. People said, we have to pay because this is much more efficient
for the government.
For the government, it comes in a format that they can quickly process.
Fewer mistakes.
Absolutely. So it's much more efficient for them. There are e-file mandates that typically states, although not the federal government, impose on paid preparers, such as H&R Block. Because we are a paid preparer and we are receiving income from a taxpayer for preparing this tax return, we are required to e-file tax returns as the paid preparer.
Okay.
And if a client wants to opt out, they may do so. But they have to sign off and say, I elect to mail my return. You may still mail your return. It is the client's option, and basically the default option for us is we want to e-file your tax return, which honestly we prefer. If there is an issue, we know it the next day. If there's something on a tax return, if somebody has already claimed a child as a dependent, if you said to me that, no, I didn't get any veterans benefits, I didn't get that $250, I will know the next day if there's a problem with your return.
Okay.
And there aren't many problems, but the ones that there are, we can solve them quickly. It's not like you have to wait for the return to be mailed and opened and scanned and processed and a letter comes and, so that's more efficient for everybody, I think, because we want, if you have a problem with your tax return, we want to help you solve the problem as quickly as possible and not drag this out till June, or sometime during the summer. So we prefer e-filing for that. I mean, it's much more accurate, and e-filing is included in our tax preparation cost for any returns that we do. So New York State also has a mandate for filing corporation and partnership returns electronically. I mean, so that is the way of the future.
It's coming. Yes, everybody's going to be doing that.
Yes.
And I'm glad.
Yeah. And that said, though, if you want to do your tax return by paper and pencil, as you have for years, and mail it in, you may still do that.
Without a penalty.
Without a penalty. Okay. Just don't owe too much.
Right. One more area I find, maybe I shouldn't say confusing, but it seems like the rules have been shifting and changing. And it varies from one company to the next.
Okay.
And that is the internet sales tax. I know at one point you bought something from Amazon. There was no sales tax, because who knows where Amazon is, in a cloud somewhere.
Right.
And so that was wonderful, but the government made them start charging taxes.
Right.
But if you buy from another company, they don't charge taxes.
They don't charge taxes.
And then at the end of the year, we're confused, and the government says, well, how much did you buy where you didn't pay taxes? And I'm like, I don't know.
Right. Well, New York State is a state, and I'm not going to use the right term. It's let's just call it a destination state. Okay, if I order a product online, and I have it shipped as a gift to a friend in New Jersey. It goes to New Jersey, it's a gift, it's done. If I have it shipped to me here and no sales tax is collected, and then I'm going to take this gift to New Jersey when I go visit my friend, I'm liable for paying New York State the sales tax on that gift on my tax return at the end of the year. Every state is looking for revenue. This is one area where they're looking for more revenue. More and more you do find Amazon, major online retailers often now will collect sales tax. If you do a lot of this stuff, you need to pay attention to it. If you owe tax, the state rule is you need to pay it. You're responsible for keeping track of this on your own. There's a line on your tax return. You can put in an assumed amount. I say an assumed amount based on your income. The state says if your income is in this range,
they have a table of some
They have
sort.
a table. They have, if your income is in this range, we've determined that the average person spends this much out of state on where they don't collect sales tax, and then bring the product back to New York State. So, now if you pay tax in the other state, you've paid the tax there, you don't have to pay it again here.
Right. Personally, I wish they could either decide to do it or not do it. And
Right.
Instead of this in between, I know that a lot of organizations will put a little symbol on their website, which if you click it
Right.
and you buy your books or whatever through that,
Right.
then you get something back from Amazon. But in California, I just read yesterday,
Okay.
there's a bill that would be a deal between Amazon and the government that would take that away.
So I think we'll probably see more and more of that, just again, because so many states are looking for every piece of revenue that they can find, and that's kind of an untapped source. Now, every so often people say, well, I hear the state has people sitting over in the outlets in Massachusetts to see cars with New York State plates. I've never had that actually confirmed by anybody, But and this is kind of an honor system.
Well, that's what makes it even more confusing.
Right.
You wonder, what are my neighbors doing? Am I a fool?
Am I a fool for doing this? And then you'll find many people who say, just put whatever the standard amount is, because I do some, I don't want to figure it out, and I want to be covered. I don't want them questioning me later on, saying,
Where's the money?
did you ever buy something online? And it's hard to keep track of. I mean, personally, if I don't do that much online, I pay attention. If they've collected New York State sales tax, I forget about it. And if they haven't, I just put it in I put my receipt in a little file.
So you just print it out and put it in a file.
I print it and keep it separately.
And then you can compare those to the standard amount and see if you're unusual or
right.
you shouldn't be paying so much.
Exactly. Well, it depends how much you do online.
Yeah.
I mean, that's the other thing.
Any closing things? What did I leave out that we just shouldn't?
Closing things that we shouldn't.
Any mistakes people are making that you're saying don't do that?
Don't do that. I think in closing, probably the most important is to make sure that you have all your paperwork before you sit down and start to work on your tax return. A lot of people are waiting to get their 1099-B statements from brokerages for consolidated statements. We are starting to see people who forgot that they had a job for the first 3 weeks in 2009 and moved 2 times and just got their W-2. If you've already filed your tax return and you get something to add to it, you need to amend your return. You can't just add it on next year or wait and let the government, well, you can wait and let the government make an adjustment, but again, it's better to deal with it as close as possible to the time you had the income.
Great. We could probably go on for 3
hours.
and I would be so confused by the end because I don't know how you keep all this straight, but
Practice.
Yeah, you live in it.
I live in it, right. And classes. I mean, we take classes to be certified and to be informed about changes. Yeah. So.
Thank you so much, Pat.
Well, it's been a pleasure.
Great.
Thank you, Richard.
Thank you. And I want to thank you for watching. I hope you enjoyed the show, that you get something out of it for the 2009 tax season, and that you have a great week. Take care.
Welcome to Channel 17, the Town of Colonie Government Channel.